Starting and Managing an Entrepreneurial Venture, Unit 2 from Chapter 10, Lesson 4, Part 2.
Launching an entrepreneurial startup. Once an entrepreneur has an idea, there are often very defined steps that they follow, such as writing a business plan, choosing a legal structure, and then, of course, trying to arrange financing. The first important step, of course, is having an idea, and this again brings us back to the concept of motivation. People have different reasons for starting a business. It could be that they're joining a family business, trying to control their future. As we said, that desire for autonomy to be their own boss can be quite an important motivator. It could be to fulfill a lifelong dream. And then, of course, there are survival entrepreneurs that were downsized or retrenched and felt they had no other choice but to start a business. But that's only one part of the equation. The other important thing is where on earth you're going to get your idea for your new business. What's quite interesting is that an in-depth understanding of the industry or profession is by far the most prevalent source of new business ideas. And this probably means that people didn't start off as entrepreneurs, but started off as employees in an industry developing a really good understanding of how things work. Another important contributor of ideas is spotting a market niche, something that was perhaps in plain sight, but that no one else could identify as a massive opportunity. There are also a small percentage of ideas that come from brainstorming and just desperately trying to find the idea for your new business. Of course, there's copying someone else, and you can see this as a very small contributor to new business ideas, because unless you're going to do it better than the originator of the idea, it's unlikely to lead to huge financial success. And then some people also manage to turn their hobbies into new businesses. Once an entrepreneur has come up with an idea, the next commonly agreed on step is writing a business plan. This has to start with a very clear and compelling vision. If people reading the business plan aren't captured by this vision, they're unlikely to read the rest of the document. Another important component of a business plan is often a look at the financial projections. These have to be feasible, otherwise they're likely to put off future investors. But it can be very difficult to estimate future income in an unknown or new market. Of course, that brings us to who the company is going to try and sell their product or service to. This is to be quite clearly delineated. And unless we're operating in a vacuum, we probably have to mention who our likely competition is and how we're going to face them in the market. Next, we need to outline the team of people that will be working on putting this idea together. There are a couple of keys in putting together the business plan. It must be well written. There shouldn't be formatting or spelling mistakes. It shouldn't be too long. We should be very clear about what the potential risks are and how we plan on mitigating those risks. It's also ideal for us to identify where the funding is going to come from and what exactly we're asking from readers of this business plan. And then, of course, we've got to capture the attention of our reader with a great summary. What's quite interesting and prevalent in entrepreneurship circles is that the business plan is quite an annoying document to set up. So I've heard many entrepreneurs lament that this is part of the process and say by the time they set up this business plan, the opportunity has potentially already passed them by. So from a teaching perspective, if we are trying to train an entrepreneur, we're always trying to teach them how to think through the issues that they have to face and how they will face these. And in that way, the process of putting together a business plan can be quite useful for an entrepreneur. But it must be said that some opportunities come very quickly and entrepreneurs have to be ready to take them just as quickly. Before an entrepreneur can begin their business, they must choose an appropriate legal structure. It must be mentioned that they could start with one type of structure, and as the business grows in size and complexity, they could move to other structure types. The three most prominent ones that we're going to look at is a sole proprietorship, a partnership, and a corporation. And each of these has their own characteristic. A sole proprietorship is an unincorporated business. It's not listed on any stock exchange. It's often in the name of the starting individual. and it's owned by that individual for the motive of profit. It's quite an easy legal structure to start a business with, not so much paperwork, for example, but one of the downsides is that the owner of the company has unlimited legal liability in the event that something goes wrong in the business. The next structure to look at is a partnership. This is also an unincorporated business, but it is owned by 2 or more people. In South Africa, for example, this is up to 20 partners. Of course, in any kind of partnership, we have the potential that partners won't always agree, and so we have to put certain things in place. How will disputes or disagreements be handled, for example? In the event that something goes wrong in this kind of ownership type, there is again unlimited liability, but this is shared by partners according to their portion of ownership. A more complex type of ownership is the corporation. This is an artificial entity, and so it means that it takes on a life apart from its owners. If the owners of the business die or move on to another business, the corporation continues to exist. And because it is a separate entity, legal liability is vested in the corporation and not the individuals that started the company. That might sound very attractive for a new entrepreneur, but it is very expensive to set up a corporation, and it does mean that the entrepreneur has to comply with complex paperwork and auditing expectations from the get-go. The next step in the process is arranging financing, and there are 2 categories of sources here: debt and equity. Debt financing is often money that is provided to the business, but that must be repaid or for which interest is due. So each type of financing has its own types of risks and rewards. The risk here, of course, is that the business must have the cash flow in order to meet the debt obligation. There are several different sources here. It could be as simple as family and friends. It could be applying for a bank loan or through a finance company that invests in high potential ideas. Perhaps the business person or the entrepreneur who's starting this business has a personal credit card or has access to wealthy individuals that they can tell about their idea and who might be willing to invest. There's also a category of investing here called angel financing. And these are wealthy individuals that not only provide money to the startup, but also advice and contacts. And so there are additional benefits to this type of financing. The other category of financing is equity. So here, money is provided to the entrepreneurs, but this money is provided in exchange for giving away ownership or a part of the ownership of the business. And this can be quite daunting for an entrepreneur, but means that they don't have the same debt obligations as with debt financing. Normally, an entrepreneur has to balance the risk between having debt and giving too much ownership away in their company. 2 interesting forms of equity financing are venture capital firms and crowdfunding. Venture capital firms are in the business of providing money to startups. They really favor biotechnology and technology firms because it's easy for them to envisage the high returns that they would get. Crowdfunding is a very interesting development in entrepreneurial financing, and several acts have been passed to allow this kind of financing. It's often run through a website. Kickstarter is a very famous version of this, where thousands of individuals can contribute small amounts towards ideas that they believe in exchange for a small amount of equity in the firm and being a part of realizing an entrepreneur's vision. Here you can see a visual representation of some of the sources of startup capital that we've just discussed. Quite interestingly, loans from friends, family or business associates, bank loans and lines of credit are quite small contributors to sources of startup capital, as is venture capital. And that is not because venture capitalists are not investing a great deal of money, but rather because they have such specific interests in certain kinds of industries. By far the highest category, at about 80% of startup capital, is businesses that are self-financed by the entrepreneur from their savings or credit cards. So they are investing in their own idea with their own money most of the time.